This lecture will cover the CFA Level 1 reading on monetary policy. Let us start with monetary policy objectives and specifically what are the goals of the Fed. The Fed, as you probably know, is the central bank in the United States. In Pakistan, the central bank is the State Bank of Pakistan, and this is the entity which drives the monetary policy. Let's focus on the Fed, and most central banks in the world will have similar goals. The most important goal of the Fed is to minimize inflation, which means to keep prices stable. The second goal is to minimize unemployment, and the third is to ensure moderate long-term interest rates. How are these goals achieved? A simplistic answer is that the Fed tries to keep growth rate of the quantity of money roughly equal to the growth rate of the potential GDP. In the United States, stable prices generally means inflation of 1% to 2%. The Fed focuses on the rate of increase of core CPI, which is the regular CPI but with food and energy prices removed. This is because food and energy prices are very volatile, and in order to have more stability in the metric, the central bank or the Fed uses the core CPI. So for the core CPI, the basket of goods does not include energy and food. The Fed also focuses on the business cycle and specifically on differences between actual GDP and potential GDP. In terms of the business cycle, we have an inflationary gap when actual output is greater than potential output, and a recessionary gap when actual output is less than potential output. A quick illustration which will serve as a refresher. So let's look at a situation where we are looking at real GDP on the X and price level on the Y. If this is our potential GDP, what does this situation tell us? So aggregate demand, short run aggregate supply. If this here is the actual output, in this case the actual output is less than the potential output, so we have a recessionary gap. When the actual is greater than potential, then we would have a inflationary gap. So the central bank wants to minimize these gaps, and if we are in a recession, the central bank would want to push us to the right. If we have an inflationary gap, the central bank would want to push us to the left. How does the Fed conduct monetary policy? The first concept to understand is that of a monetary policy instrument. And this is a variable the Fed can control either directly or very closely target. The two most important monetary policy instruments are monetary base and short-term interest rates. The Fed can set one but not both. If the Fed decides to control the monetary base, and let's say if it reduces the monetary base, then interest rates will automatically rise. We'll see this illustrated on the next few slides. On the other hand, if the Fed focuses on interest rates and decides to increase interest rates, then the monetary base will automatically decrease. So the point is the Fed will control one or the other, and it cannot change both at the same time. The Fed's preferred instrument is the federal funds rate, which is the rate on overnight loans that banks make to each other. This is an important slide. It talks about what strategies are used to determine the federal funds rate. So let's say we have said that the federal funds rate is the monetary policy instrument that we are concerned with. And if we are in a situation where inflation is high and there is a inflationary gap also, what must the federal funds rate be in order to move the economy back into equilibrium, or move the real GDP or the actual GDP back to potential GDP? And there are different strategies. One set of rules that can be used to determine an appropriate federal funds rate is called instrument rules. These rules set policy instrument at a level that is based on the current state of the economy. The best example of an instrument rule is the Taylor rule. And let's look at how the Taylor rule works. Basically, you need to memorize this Taylor rule formula. So if the Fed has targeted an inflation level of 2%, then it must set the federal funds rate equal to, then according to the Taylor rule, it should set the federal funds rate equal to 2% plus the current inflation plus 0.5 times current inflation minus 2%. The 2% target is showing up here and here in the formula. So the current inflation minus 2% plus 0.5 times the gap. This is the gap between actual GDP, so actual GDP and potential GDP. Take a specific example now. If the output gap is 1%, this means that actual GDP is 1% more than potential GDP, and actual inflation is 3%. What must the federal funds rate be? So let's apply the Taylor rule formula. So the federal funds rate must be equal to 2% because this is the target inflation, plus 3% because that's the actual inflation, plus 0.5 from the formula, 3% actual inflation minus 2% target, plus 0.5 times the gap, which is 1%, and this will give us 2 and 3, 5, plus 1 is equal to 6%. So in this situation, the federal funds rate will be set at 6% according to the Taylor rule. What I want you to do now is just pause and take a few more numbers for the output gap and inflation and try to come up with the federal funds rate according to this formula. You need to learn this formula very well. Another category of rules are called targeting rules, and a targeting rule sets policy instrument at a level that makes the forecast of the ultimate policy goal equal to its target. So the core point with targeting rules is that it focuses on forecast numbers and it wants to make the forecast of the ultimate policy. So let's look at an example. If the policy goal is 2% inflation rate, then set the federal funds rate at a level that makes the forecast of inflation equal to 2%. So let's say that based on the current state of the economy, the Fed wants to set the federal funds rate at 6%. How will it accomplish this using open market operations? Before we get into the details, let's just recap some important points. The Fed achieves interest rate through open market operations. Open market operations is the purchase and sale of government securities. When the Fed buys securities, bank reserves increase. When Fed sells securities, bank reserves decrease. Now, given this picture, the federal funds rate is at 6% because the supply of bank reserves intersects the demand for bank reserves where the federal funds rate is 5%. If the Fed wants to increase the federal funds rate to 6%, what must it do? It must shift the reserves supply to the left. So the supply of money or the bank reserves must go down. How can the Fed make that happen? The Fed will make that happen through open market operation. Now, will the Fed open market operations, as we just saw, is the buying and selling of government securities. So will the Fed buy or sell? And the answer is that what the Fed wants to do is reduce money in the banking system. To reduce money in the banking system, the Fed is going to sell. So sell government securities. When the Fed sells government securities, money leaves the banking system, and hence the supply of reserves at banks will go down. This line will shift to the left. There is no change in the demand curve, so the new federal funds rate will be 6%. So essentially, the Fed makes the quantity of reserves supplied equal to the quantity of reserves demanded at the federal funds rate target, which in our example was 6%. How does the Fed fight a recession? If inflation is low and real GDP is below potential GDP, the Fed takes actions that are designed to restore full employment. And here again, just to refresh your memory and set the context, this is the picture that you should be very familiar with now. So this is real GDP, this is price level, potential GDP. The recessionary environment means that aggregate demand and aggregate supply intersect before to the left of the potential GDP. So now the Fed wants to kick the economy out of the state. What it will do is it will lower the target rate, so it will lower the federal funds rate. As we saw in the previous slide, the supply of money will increase. When there is more money in banks, more reserves at banks, that will increase the supply of loanable funds, and this lowers long-term interest rates, which causes investments to go up. When investments go up, what happens to the aggregate demand curve? The aggregate demand curve will shift to the right. So we essentially then, what the Fed has essentially done is kick the economy out of a recession. Let's take a slightly more detailed look. And this slide here helps illustrate that, simplistically put, there are three markets for money that we will be concerned with. One market deals with the very short term interest rates, which we have been calling the federal funds rate. So these are the rates on overnight loans or extremely short term loans between banks. And what's happening here? In this case, the Fed has increased the supply of money. So the supply line shifts to the right and the federal funds rate goes down. Then the second type of money that we'll talk about is has to do with short-term rates. So this would be 3-month T-bills, 6-month T-bills, etc. When very short-term rates go down, then short-term rates on T-bills and so on will also go down. So notice that the rates in the money markets will also go down. And this point is interesting. An increase in monetary base increases the supply of money, the interest rate falls, and the quantity of money demanded increases. So we are now at this point. Then number 3, this is more long term, and here we are talking about loanable funds, the funds that are lent out, that the bank lends on a relatively longer term. An increase in the supply of loanable funds lowers the long-term interest rates and investment goes up. As we discussed on the previous slide, when banks have more money, there'll be more funds for the bank to loan, and therefore the supply line, this is the supply of loanable funds, this line will move to the right. When that moves to the right, interest rates go down and the new equilibrium quantity of loanable funds moves to the right, so that goes up. So long-term interest rates go down, investments go up. If investments goes up, what happens to the aggregate demand? That kicks to the right, and then we also have a multiplier effect. So eventually, ideally, we end up at this point where we are back at potential GDP. How does the Fed fight inflation? If inflation is too high, then and the real GDP is above potential GDP, the Fed takes actions designed to lower the inflation rate and restore price stability. I want you to pause this video here and go through these slides. The logic is like what we just saw, but in reverse. So make sure you can go through this and interpret what's going on. What are some monetary policy limitations? Monetary policy does not always have the desired effect. There is a loose link between short-term and long-term rates. In the explanation that I just gave, it looked very simple. It seemed like when we reduce short-term rates, the long-term rates will also go down. While this is the likely scenario, but there can be other factors such as inflation which can impact this relationship. So if inflation is very high or expectations about inflation are changing, then this simple relationship might not hold. Another factor is that the monetary policy transmission process is long and drawn out. While short-term rates can change fast, so let's say they go down, it will take weeks potentially for the long-term rates to go down, and maybe months or more for the aggregate demand to actually be impacted. Because long-term rates going down, it will take a while for that to impact investments, and then that in turn will impact aggregate demand. But the point here is that the whole transmission process that we've talked about can take a long time. What are some alternate monetary policy strategies? The way you can think of this is the strategy that we've talked about so far and simplistically represented by the Taylor rule and setting the federal funds rate so we can control inflation. So that in simplistic terms is what is used by the Fed. But what are some other strategies? And specifically, these 4 strategies are what the CFA Institute wants you to know. So let's take each one and understand a few bullet points related to them. One of the strategies is the monetary. So number 1 is monetary base instrument rule, also called the McCallum rule. This has a focus on the growth rate of the monetary base, and this says that M, which is money times velocity, which means how fast money is used, is equal to the price level times the output. So what this strategy tries to do is match the growth rate of the monetary base to the long-term growth rate of the GDP or the output. And if velocity is constant and price levels want to be kept constant, then M simply needs to increase at the same rate as Y. If there is a inflation target of 2%, then we factor this into the growth rate of money. If velocity is not constant, then we also factor that into the growth rate of money. The drawback of this strategy is that it relies on stability of money demanded and the monetary base, which does not always happen. This strategy is rejected by the Fed because shifts in demand for monetary base cause large fluctuations in aggregate demand and severe business cycles. So bottom line is this is rejected by the Fed, but as a CFA candidate you need to know this anyway. Money targeting rule, this is attributed to a famous economist, Milton Friedman. According to the money targeting rule, you should grow the money supply at the rate of increase of potential real GDP. This assumes that velocity is constant. So this is very similar to what we just saw, and hence the drawback is also similar, which is that fluctuations in velocity of money and demand for money can lead to interest rate swings and consequent variability in aggregate demand for goods and services. This strategy is also rejected by the Fed. Number 3 is the exchange rate targeting rule, which tries to adjust money supply growth rate so that exchange rate between a country's currency and basket of currencies of other countries remains stable. An example is the UAE, which has its currency pegged to the dollar and is considering a peg to maybe a basket of currencies in the future. But the drawback of this strategy is that the inflation rate would be that of other countries in the long term, and the monetary policy will have little control over inflation. And hence this strategy is also rejected by the Fed. Finally, you need to know a few points related to the inflation rate targeting rule. According to this rule, central banks make inflation expectation explicit, and then central banks explain how policy actions will achieve this target. It uses open market operations and manages the overnight rate to bring expectations in line with the target rate. So if the target rate is 2% for inflation, then all the actions that the central bank will take will be made transparent, and those actions will be such that the economy moves towards an inflation rate of 2%. This strategy is used by many central banks including the Bank of England, the central banks of Canada, New Zealand, and Sweden. So that is it for monetary policy. You need to now practice as many questions as possible from the curriculum and your study notes and whatever other sources you have access to.